More inverted yield curve silliness, my friends. So let's read this article. Why buy the long bond when the future is so uncertain and higher returns are available in the money market, said Mr. Reed. Yields in the money markets range from slightly less than 14% for treasury bills on a bond equivalent basis to almost 15.5% for large certificates of deposit issued by commercial banks. Among the new treasury issues sold this week, the 14 5/8% notes due in 1985 were offered late yesterday, yielding 14.8%. And what was the 30-year doing? Let's take a look, shall we? The 30-year was yielding. The Treasury sold new 14% bonds at an average yield of 14.56% for the new 30-year issue. Thus, in 1982, February 5th of 1982, you could have bought a inverted yield curve, a long bond Treasury at 15 and 14.5, right? Which is the highest ever. Or, like our guy from T. Rowe Price says, why buy the long bond when the future is so uncertain and higher returns are available in the money markets? That was in 1982. All right, so I had to throw that out there to you because, let's see, what was the beginning of the biggest economic expansion the world has ever seen? Anyone? Bueller is in 1982. All right. So it was in 1981, Business Week said the death of equities on their front page of their magazine. And that was a sign for sure, in hindsight, that that's when you should have been buying. But actually, it turned out to be 1982 to 1999. There has never been ever an economic expansion of such immense proportions in the history of the world. And yet, here's our man here. Why buy the long bond when the future is so uncertain and higher yields or higher returns are available in the money markets? In fact, you could, if you want to dive in deeper, you can see they're getting 18, even 21% in CDs and money markets and shorter term bonds. Yeah, and that's a guy from T. Rowe Price, which is why, again, these guys don't know. But I thought this was pretty interesting. Here's a guy, this guy right here. I'll show you. This guy, James Lowry, who's president of an investment banking firm bearing his name. I think it's called Alliteration. Is that right? I don't remember. I just don't see how the investor can lose with yields this high. And if James Lowry is still around, he's a man of the hour, because if he was loading up on those, is actually about 15.25. You could buy these bonds in 1982, these 30-year treasuries later on this year at 15.25. And lock them in for 30 years. So you not only had 15% guaranteed per year from the feds, but they also went well into 15% in 2000, the beginning of 2000, all the way through the end of 2000, the first decade of 2000. You're getting 15.25. Well, the stock market was going like this, the bond market was going like this, everything else was falling across. You were getting 15.25. So our man James Lowry, RIP. I imagine he's probably not with us anymore, but that's a pretty good deal. That's the inverted yield curve. Actually, I just watched Graham Stephan's video on the inverted yield curve, and that was a good one. I'll put a link in the show notes. I thought it was actually a real good video. He talked about it too as well. He doesn't use the same terms I do, the silliness of it all, but I do. But he just showed, he showed you, part and parcel. Here's the inverted yield curve. Here's what happened, and here's what happened. Oh, yeah. It's a dot band. It's just this. It's financial pornography. Come on. This is what the naysayers got to sell you to keep you nervous, so you keep, they get money every time you click on it. Let's see. Government securities dealers said that investor demand strengthened yesterday afternoon when prices were much lower than earlier in the week. Prices much lower mean the demand will be dropping, which also means the yields go higher. So now the yields go higher, the investor demand picked up. But overall, they described demand as modest. The dealers said they owned the vast bulk of the securities bought at this week's auction. So basically, they weren't even selling them to their clients. They were keeping them essentially in inventory. Bankers and advisors acknowledged that the yields of more than 14% were attractive compared with recent inflation, but they offered a variety of reasons why investors were not more enthusiastic. Illustrating the slowdown in inflation, the CPI rose only 9.6% in 1981, which is down from 12.5% in 1980, and is expected to increase just 7% this year. And then, who's this? Lowry says, traders are going to send the market up and down, and it will be foolhardy to get in their way. But I think the continued decline in inflation will be recognized one day and lead to the biggest bull market for bonds you ever saw. Man, I wish that is. The 14% issue could easily trade at a price of 150 if the market gets going. Man, this guy right here, James Lowry, you are the man. You are the man. I got to do some research on this guy because here's James Lowry. He said it. I think the continued decline in inflation will be recognized one day and lead to the biggest bull market for bonds you've ever saw. The 14% issue could easily trade at a price of 150 if the market gets going. Man, that guy was 100% spot on. But then you got the guy from T. Rowe Price who's the exact opposite. See, that's what I'm saying. There's always got to be a buy and a sell in any transaction in the securities market, any market. You got to have a buyer and you got a seller. So the guy from James is loading up on these bonds. The demand is tepid. And he's like, I'll buy them because this could be the biggest bull market we've ever seen in bonds. And he happened to be 100% right. This guy should have got the award from Louis Roykaiser Wall Street Week for being that spot on, where the guy from T. Rowe Price is 100% wrong. He kept saying, oh, inflation, risk, blah, 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 sentiment, blah, blah, blah. And he kept rolling over his CDs and short-term bonds at a lower and lower rate. And yet our man James, man, that's fantastic. The improvement in the inflation rate to a current level of about 8% has not helped the long-term bond market easily absorb large offerings, such as this week record 2.5 billion. Man, they're only issuing 2.5 billion of 30-year treasuries back then. Man, wouldn't it be nice to be issuing that few bonds now? He said that investors have learned they can buy issues due in 5 years or so and still earn a high yield and profit from rising prices if yields fall sharply. According to institutional salesmen in the government securities market, maturity extension for most portfolio managers these days mean issues due in no more than 10 years. Again, so the demand for the long bond was just not there. Thus, the inverted yield curve. In fact, they say the only remaining buyers of 30-year treasury bonds are the state and local government employee pension funds and individuals, which is actually, that's interesting. And then our man, James Lowry. James Lowry is our hero. And everybody else is our what's the protagonist, antagonist? So think about that. The pensions, state and local governments, this actually makes it even scarier for the pensions because they might have got a, what's the word I'm looking for? They might have got a free ride because they were somewhat forced to buy these long-term bonds to fund their pensions, which meant they're getting above market returns by luck because they were the only game in town to buy these long bonds, which turned out to be a wonderful, wonderful investment. And now that those days are gone, they're not going to get that free ride anymore. That's scary because the pension obligations are much higher and the interest rate they're getting are much lower. That's not good. Let's see here. Anything else I want to talk about this? No, I guess that's it. Yeah, all right. So that's pretty much it. This is from the New York Times. Record set on 30-year U.S. bonds. I tell you, man, I love this stuff going back in history. Just remember, 1982 was the biggest start of the biggest bull market for stocks and bonds that we've ever seen. I'm going to look up our friend James and see. Actually, let me pause real quick. I want to see if he had any other stuff that we're thinking about here. Hold on a second. I'll pause. Well, here we go. James Lowry. This is written in 2009, and that's his house. I think right there, James Lowry's house. As a successful investment banker, investor, and developer, after retiring as general partner of Salomon Brothers, where among other assignments he advised large municipalities on their finance, he launched Catalyst Energy Corporation, where he served as chairman and CFO until the company was sold in 1988. He is a principal in Navarro Lowry Real Estate Development Company that owns and manages properties in Florida, Texas, and Colorado. And then so he's made some money, man. That's for sure. Look, man, I'm a capitalist. I got no qualm with that in the least, none whatsoever. How do I move this guy? Let's see here. How do I go back? Let's pause. And here's from Bloomberg. Talk about James Lowry, age 79. Okay, what's the date on this? Let's see. He chairman of the board and co-chief executive of Extreme Systems. He serves as the chairman of the board, member nominating, blah, blah, blah. He served as co-chairman of Extreme Systems from March 2009 to August 2009. Okay, so basically same thing. So I can't tell if this guy's since passed or not, but he got an MBA from Columbia, a JD from New York University. Anyway, it's interesting to follow how some of these guys are shaking out after they, became prominent in the investment world. So interesting. I wonder if Salomon Brothers actually bought out the Lowry Investment Bank. There's a book back there about Salomon Brothers. I forgot what it was. How they, man, what was that? I can't remember what the book was. It didn't make him. It did not shed Salomon Brothers in the greatest of light. That's for sure. Let's just go back real quick. University of Berkeley, UC Berkeley School of Business. Let's take a look. Retired Wall Street banker, healthcare investor James Lowry, senior vice president. That's probably not him. Health. Okay. Future investment management, says James Lowry on YouTube, and it's interesting. That James J.R. Lowry, that's not the same guy. But I don't know, man, because let's see, UC Berkeley Haas School of Business. Looks like he donated some money, 2007, and there he is. Have founded the Share in Business. The new endowment is intended to support the teaching and research of a faculty person who studies the behavior of financial institutions from a microeconomic perspective. Anyway, it's interesting to me, so I'm just going to keep reading for a second. No industry is changing, says he, and most major problems in the economy are first incubated in the financial system. Isn't that ironic, because this is summer 2007. Microeconomics is a discipline that underlies why banks, hedge funds, and other institutions do what they do. Really? My intention of supporting a Haas faculty member in this area is to enhance the way the top flight school helps students understand financial institutions, blah, blah. All right. Well, that's interesting. He's an avid golfer, skier, windsurfer, sailing enthusiast, fox hunter, a rich guy. And man, in this case, he made, if you were his client in 1982, he made you a lot of money. I got no problem with that at all. Don't pay any attention to the inverted yield curve. I'm telling you, man, what are you going to do about it? Stop. All right, we'll see you next time.